As far as Malaysia is concerned, a lot of our investors, our homegrown investors, have a bias for big investments into Malaysia. The EPF itself has a default weighting kind of in Malaysia as well. Do you think that this home country bias is healthy, and does it actually go against the idea of full diversification?
I think when you're talking about managing pensions, whether it's public pensions or your own individual retirement investments, it is important to match your investments or your assets to your liabilities. So if you're a Malaysian investing your money and intending to retire in Malaysia, it would make sense to have a larger portion of your investments in ringgit assets. I don't think one would want to take the unnecessary risk of diversifying for the sake of diversification and expose yourself to a mismatch in terms of your underlying assets and your future liabilities. Right? Having said that, however, I still believe that some form of diversification is a positive. When you're referring to the EPF, I can't speak for them, but just anecdotally from what they've said in the media, in briefings to the public, we do note that the EPF is one of the many public institutions in Malaysia that have been increasingly diversifying away from Malaysia.
But there is still very much home-based weighting as far as EPF investments are concerned, and the marginal investments that they are making overseas is still quite small at the moment. And also your point about matching assets and liabilities, if in the event that something happens to the Malaysian market, if let's say the Malaysian market crashes, then that matching of assets and liability would go against the investor, wouldn't it? Because they have a double whammy there.
I think we can't legislate for multiple scenarios, but you're right to say that if all your eggs are in Malaysia and Malaysia goes through a downturn and it hits you at the point when you're retiring, then it would have been a bad decision. But if one were to assume that you don't suffer from such bad luck and things are normal in a normal environment, then yes, you would still want to have the bulk or at least more than half of your assets invested in the country that you're going to retire in. Yeah? And I agree with you, some diversification is necessary, and then exposes you to different risk factors, different market dynamics or economic cycles.
As far as looking deeper into the Malaysian economics are concerned, consumer spending in Malaysia now accounts for about 53% of GDP. This is certainly expected to be impacted negatively from Malaysia's subsidy rationalization. But will this necessarily translate to a negative impact for the stock market, the local stock market?
It will definitely impact consumption, as you rightly pointed out. Whether it will impact the stock market is a little bit more difficult to say. I don't think there's a direct correlation between reduced spending and stock market performance. I think the stock market can still deliver returns if some of the other factors are in place and remain. So one of the key factors that we talked about, which may seem counterintuitive, is the fact that the Malaysian government has embarked on a reform path of reducing subsidies, of increasing tariffs. And while we may think that yes, this would reduce consumption spending and therefore would not be a positive for the economy, it could be viewed as a positive in the fact that we are addressing some of the structural issues that have plagued Malaysia for the past 16 years. And foreign investors may actually like it. And when we talk about the markets being fairly valued or a bit more expensive, that is only at the index level. If one were to delve below and look at the entire market, which I think has about 1,000 listed companies, I believe we can still find opportunities.
Now let's talk about the biggest elephant in the room in Asia. China was the worst performing market in Asia last year, down 7%. It is still only about 1/3 of its 2007 peak versus all-time highs for many other global and Asian markets. Is the worst over for China?
We are positive on China. We believe, just reading on the recent developments that's coming out of China, we believe that they are more serious about the reforms that they have announced. For example, the president that will be leading, that will be involved in the leading group in overseeing the reforms, the economic reforms that they have announced in the third plenum. So there are a lot of China skeptics out there who have seen it all before. They announce all these broad policy which they fail to execute or follow through. But I think this time it is slightly different. I believe this time the political will is there. And it will be gradual because that's a Chinese way of doing things. It will be gradual, but I firmly believe that they are serious about the reforms.
Is Asia at risk of imploding from excess credit? China currently is 160% of GDP banking credit to GDP. Hong Kong, Singapore, GDP banking credit to GDP ratios are at all-time high. And then if we add the performance, the very good performance of the property sector in Hong Kong, the property index is up 140% over the last 5 years. How risky is this credit situation in Asia?
If you're referring specifically to property, the property sector, yes, I believe you have seen, in fact, I think in Hong Kong and Singapore, we've recently seen latest price points coming down, right? After numerous months or years of price increases. So that's inevitable. I think the authorities in the various countries that you mentioned have also implemented measures to cool down the property sector. And I continue to believe that the property prices in these countries will come off. I would expect it to be gradual in nature because I don't foresee a credit crunch.